This changes literally everything, and a whole bunch of traders and investors are going to get left behind if they don't understand this. The market absolutely ripped on Friday because of what Jerome Powell said, which has massive ramifications for this week, next month, the rest of the year, and moving forward. There's actually a permanent change that the Fed implemented into their wording, and it has massive repercussions. And the market's already starting to realize this and is already pricing things in. So you can see the numbers here from last Friday. The market absolutely ripped. Amazon up over 3%, 1.2% for Apple, Google 3%, Meta 2%, Nvidia 1.7%. It's there's not many things that are red here on the charts, and I'm going to break down for you exactly why this is happening and where the opportunities lie. So first things first, the stock market is at an all-time high. Powell puts the market on party mode. There was a whole bunch of traders at Lark funding that got just destroyed on Friday because they didn't align themselves with a Jackson Hole, what was coming, what Powell said. There's also a lot of traders that made a lot of money. So you really have to understand what is going on here if you are going to trade effectively. So what actually happened? Jerome Powell finally showed up at Jackson Hole on Friday, and he did not ruin the vibe for the market. Instead of slamming the door on rate cuts, he basically said, yeah, interest rates are still high, but risks are shifting, so we might ease up, aka interest rate cuts in September and in 2025 are well on the table. Translation, Fed might actually cut in September, and the Dow Jones ripped to an all-time high, up more than 600 points, while Treasury yields slid. So you can see here, all-time high for the Dow Jones, 45,631. So if you just go back to April, when everyone was freaking out about tariffs, World War III headlines coming, it was all a nothing burger. We have absolutely ripped from the lows, and traders and investors and everyone is starting to realize that the money printer is about to come back, and if you don't hold hard assets, you are going to be left behind. It is going to get very, very, very ugly for you. Now, I want to pull up Polymarket. I want to take a look at what the odds are right now for interest rate cuts in September. Fed decision in September. Right now, we're looking at a 78% chance. So last week, I think it dropped to as low as 68% chance. It's increased to a 78% chance of a 25 basis point cut in September. So it's not 100%. It's not fully caked in just yet, but the odds are rising. Now, what does this mean for traders? Well, remember, it's not about what the market's just doing today or yesterday. It's about what the market thinks is going to happen tomorrow and moving forward. And because the market knows that those rate cuts are coming, that is why the market is ripping. We're in a full-blown risk on mode. Anybody trying to take a risk off trade that's taking shorts on the wrong asset, they're getting completely burned. Why does this matter? When interest rates get cut, it means a couple of things. Number one, it's good for assets, but it's kind of a double-edged sword, and we're going to talk about that because we have to remember interest rate cuts happen when we're on the brink, historically, of a recession. There's a reason that the Fed cuts rates, and it's because the economy is looking shaky, unemployment might be rising, all things that aren't good. So we have to keep that in mind, but as an initial reaction, it is so bullish for stocks. So risk on mode is back. Lower rates equals cheaper borrowing, higher valuations, and everyone pretending we are rich again. Our take is if Powell blinks, equities, crypto, and commodities all eat. Bonds too. The only thing not eating is my wife's patience every time I tell her just one more chart before bed. So to bring it all together, stocks, all-time high. Home prices, all-time high. Bitcoin, all-time high. Gold, all-time high. Money supply, all-time high. I think if there's one major political takeaway and economic takeaway that we have to realize since Trump has taken office, is that it does not matter if we have a Democrat or a Republican in office. Blue, red, purple does not matter. Regardless of who is the president, who is in office, the money printer is going to continue, and the debt crisis is only going to get worse. And that's why we're seeing this larger divide between the rich and the poor and the erosion of the middle class. It's people who hold assets that are going to make money, and that's what we have to take away from this video. They are going to print like crazy. When stocks ripped, absolutely ripped. If we come over here to TradingView, Absolutely right. Bitcoin, we had a 4% climb on Friday. We've had a little bit of those gains taken back over the weekend. But you can see here gold up 1% on Friday. S&P 500 up 1.5%, all the way back to all-time highs. The S&P 500 did not get more valuable on Friday, okay? The reason it climbed is because the asset that the S&P 500 is denominated in got weaker, aka the dollar. What happened to the dollar index? Down 0.9%. The dollar has been getting destroyed all year. And again, we have to remember that when interest rates get cut, when they pump the system with money, what's going to happen? All fiat denominated assets are going to go up, not because they're getting more valuable, but because what they're denominated in is getting weaker. 2020, 2021, major housing boom, right? The value of homes skyrocketed. Did houses get more valuable? No, they didn't. The asset that houses are denominated in got weaker, therefore prices climbed. And that's what you have to realize as a trader, as an investor, that this is only just starting and it's going to get worse. Let's shift over to Canada. I'm Canadian, and for whatever reason, Canadians, I don't know, 3-ish months ago when we had an election, more than 3 months ago, 6 months ago, once again elected a Liberal because 9 years wasn't enough. And so what happened? Or what's happening? Well, it was all about elbows up that Carney said. We're going to fight Trump. Everyone in Canada thinks, Trump is the worst thing ever. Well, Canada has decided to ditch their retaliatory tariffs on U.S. goods. They announced this on Friday, rolling back the 25% counterpunch that's been in place since March. So Canada implemented these retaliatory tariffs in March, and they're getting rid of them. So much for elbows up. The result for traders, the USD CAD dipped from 1.39 to 1.38 on the news as markets priced in smoother trade relations. So you could see USD CAD right here. So the Canadian dollar gaining a little bit of strength on the news, likely going to be short-lived. If we pull up the USD CAD chart to see there's any opportunity, see here on the 4-hour chart, we're getting a nice retracement. I would look here, if we bounce off the 50. So I would be looking for a trade right around this 38 level, long position with those moving averages, the daily 50, the daily 100, right? Retarget all-time highs. And I'd want my stop loss, probably about 30 pips. You could probably drop down timeframes and look for something a little bit tighter, but I would probably be looking for a trade like that. Nice support, moving averages, fib retracement. So from a technical analysis perspective, that's what I'd be looking for. And again, nobody in their right mind is going to want to invest in Canada over the US. So I see no reason for why the CAD would have any sort of longer term strength. So that's what's going on with USD CAD and the Canadian dollar. Another thing hitting all-time highs, Ethereum, new all-time high. This one took a while, but it's pretty crazy. It was down big time, especially relative to Bitcoin when Bitcoin hit one of its earlier all-time highs this year. So 4,800 US for Ethereum, which is remarkable. So Ethereum is also feeling the good vibes. Why? There's nothing really that fundamental to Ethereum going on right now. It's really, again, because of the hints at rate cuts. You have to think of crypto, Ethereum included, as the poster child for risk on. So when stocks pop, crypto explodes, and traders who said they were done with altcoins suddenly forgot their breakup speeches. So remember, lower rates, more liquidity. And when liquidity goes up, it does not go into savings accounts. It flows into equities, crypto, and anything shiny enough to pump. So remember what happened with all those stimulus checks in 2020. It all went into the stock market and everything pumped. Okay. If you're looking to take a prop firm challenge, prop firms are really the gold rush right now, the gold rush opportunity for traders. I used them to quit my job in 2020, 2021. Then over 3 years ago, started Lark funding. No hidden rules, no consistency rules. We've been paying for over 3 years. And on our 2-step challenge, we have 10% max drawdown. So we are prop trading without the nonsense. I don't like the direction that the industry is going in by implementing all these really dumb rules. And so if you're looking to take a prop firm challenge, click the link down below. We would love to have you there. This is the big picture. This is what I really want us to pay attention to right now. If there's, again, one takeaway from this video, it is this. It is what is going on with the Federal Reserve. And I want to pull up this tweet right here. Let me translate. If you don't own any assets, you better find a way to get some and fast. That is the takeaway for this video. Why? On Friday, there was this very sneaky thing that took place. This has 1.7 million views, okay? Powell said the Fed has adopted a new framework that removes a reference to the central bank seeking inflation that averages 2% over time, and one to it making decisions on employment based on shortfalls from its maximum level. This is huge. Boring, yes, but absolutely huge, and you need to understand this. The Federal Reserve has two main goals. It is to maintain 2% inflation and to maximize employment. They are shifting away from that and saying employment's the most important. This is giving them leeway to abandon the 2% inflation target, aka they know, they don't want to tell you outright, but this is them coming as close to that as possible, saying 2% inflation is no longer our target. They completely exceeded that during COVID. Inflation was like 7-8%, and that was the official number. We all know, consumers all know that it's way higher than that. And this is what they are telling you, that it is coming back. They're going to print money. They need to, because the debt is so high. They need to cut interest rates so they can service the debt. And they're just going to inflate away the debt. That is exactly what they're doing. And this is as close as we're going to get to them telling you. So what does it mean? It means if you do not own assets, you better find a way to get some and fast. Take your fiat currency, which they are printing, and you use that to buy a hard asset. Not financial advice. What am I doing? I'm buying more Bitcoin. Every time it drops, I'm buying more. I'm buying stock. I'm not really a gold guy, but stocks and Bitcoin especially. But why does it matter? Remember, cutting rates, more liquidity, risk assets, stocks, crypto, love this. They fly. Ditching the 2% anchor means inflation is no longer the North Star. So cue the debt balloon, inflating faster than ever before. And remember, it doesn't matter who's in office. This train has already left the station, and there's no way that we're going back. Take a look at this. The longest bear market, the US dollar's purchasing power. This is exactly what I'm talking about. Over the last 100 years, the US dollar has lost 95% of its purchasing power. Since 2000, the US dollar has lost over 40% of its purchasing power. If this is not the best advertisement for Bitcoin ever, or any asset, I mean, you're going to get left behind. And so as traders, the entire framework that I have used is make money with prop firms, funnel that money into hard assets, let those compound over time, and get wealthy doing that. So just absolutely insane what the Federal Reserve is doing. So I expect wild swings in the DXY because of this. From a trader's perspective, you know, the dollar is going to continue to drop. Safe havens are going to do well, and then a risk on rotation is what is happening. Okay. Next up, we have a couple of stocks that we want to pay attention to. Intel, absolutely wild. The government officially bought a 10% stake in Intel for $8.9 billion. So they're using taxpayer dollars to buy a private, well, not private, but a public company. It just kind of screams of communism. I understand the reason behind it. You know, they're the only domestic company that can produce advanced chips, and Uncle Sam wants in on the action. Let me know in the comment section what you think about it. Kind of pros and cons, but it's very communist-esque. Spirit Airlines is not doing well. They're down 80% year to date. So again, that's a stock that you probably want to keep an eye on. Could be an opportunity somewhere. They crawled out of bankruptcy in March. But since then, they have not been doing well. Again, Restoration Hardware got hammered, literally down 8% on Friday after Trump launched a major tariff investigation on imported furniture. So, you know, if you're looking for stocks to keep an eye on, see where the opportunity is, that's one to keep on your watch list. If we drop down here, Meta, pretty boring stuff, but their glasses, I don't know who the heck is going to be interested in paying $800 for some smart glasses, but they're coming out with that next month. OpenDoor climbed 40%. So again, real estate is going wild. And I want to pull up, before we take a look at that insane payout, take a look at this. Home sellers now outnumber buyers by more than 500,000, the largest gap ever recorded, which is really insane. So if you're buying a house, selling a house, keep an eye on that. So again, there's things that are brewing in the economy that mainstream is not paying attention to. One of them also being this guy over here. Credit card delinquencies and debt delinquencies are rising. Credit cards, 12%, highest delinquency rate since the Great Recession. Student loans, back above 10% after payments resumed, likely to continue. Auto loans, near 5% delinquencies, approaching a 14-year high. the debt stress is piling up. So we are absolutely in a risk on environment right now. But remember, historically, when the Federal Reserve cuts rates, it's because the economy is starting to crack. And that means risk on might only be temporary. Again, not financial advice, but I would say that's my main thesis. We're risk on right now, but there are cracks that are forming and it will shift. I'm not trying to time that shift, but I'm not thinking, it's going to be risk on for 2 years, for example. There could be something else that's brewing behind the scenes. This is who owns all the Bitcoin. Just to wrap things up here, this one was interesting. So retail owns 71.8%. ETFs own 7%. Satoshi owns 5%, $128 billion. Still no idea who he is. And to be mined 5%. So kind of just some interesting figures to look at there. So that is what we have going on for today. Let me know what you guys think we are in risk on. Sign up for Lark funding down below. I'll see you tomorrow.